we start with the continuing battle over the Federal Reserve, as President Trump insists that Governor Lisa Cook must go, and Ms. Cook refuses to leave, even as the president's nominee to replace another governor heads toward Senate confirmation. Our special contributor Larry Summers has consistently expressed his concerns about Fed independence, but so far the markets have been calm. So, Larry, continued focus on the Federal Reserve as there are proceedings with respect to Governor Cook, Lisa Cook, as President Trump's tried to fire, even as they try to appoint Stephen Myron to come in. What is the significance of what's going on right now with the Federal Reserve?
I think we're on the foothills of a credibility crisis. We're not there yet because people believe that ultimately U.S. institutions endure and succeed. But between the president's demand that interest rates be cut by 3 percentage points, which no economist anywhere has endorsed any idea of that kind, between the harshness of the president's rhetoric vis-a-vis Chairman Powell, between the extraordinary effort to fire a sitting Fed governor with no kind of due process surrounding the for cause provision, between the ominous rhetoric about hijacking the process for choosing local presidents of the regional Federal Reserves, between rumors about other members of the Fed board, we are in completely unprecedented territory. There hasn't yet been a dramatic market reaction. There are some concerning things in markets, not just 1 year ahead, but 1 year ahead. Inflation expectations are trending up a bit. The spread between the 30-year bond and the 10-year bond is larger than any time since COVID, but we haven't seen substantial reactions in markets yet. But this could turn very quickly if the psychology changes. And so, frankly, I think we are playing with fire in terms of inflation expectations, a situation made much worse by the fact that the United States, unless we get a big break in terms of artificial intelligence or other technology, really has a very problematic fiscal picture.
One of the questions some economists have raised is, does it make that much of a difference to have one person on the Fed or two people on the Fed? Part of the strength of the institution is the FOMC is a group of people, and so one or two people alone cannot really change the direction.
That may be right, but what the president is talking about, what he's explicitly scheming about on his Truth Social account and in some of his rhetoric, is getting a majority of the Board of Governors and using that majority on the Board of Governors to force a majority on the Federal Open Market Committee by controlling the appointment of regional feds. So this is not a one and done thing involving just the chairman. This is an attack on the governance of the institution. I'll tell you part of what is really disturbing to me. There have been a long tradition of distinguished Republican leaders who have stood up for the importance of inflation credibility, who have stood up for the independence of the Fed. I particularly admired Senator Pat Toomey when he was on the banking committee for his efforts. But there were others. There was an effort made to deny a nomination when President Obama made it to Nobel Prize winner Peter Diamond, because he wasn't steeped enough in monetary policy and respect for the independence of the Federal Reserve. And yet here, when we're talking about the wholesale politicization of the Fed, there is no response from concerned Republicans. And I have to say that I have been struck that the prominent members of the financial community have had more to say being critical of Zoran Mondani's bad ideas about grocery stores in New York than they have the wholesale takeover of the Fed, which is a major threat to the financial system as we have it. So I am very worried that highly irresponsible behaviors are being normalized by what the president is doing and by the failure of the establishment and of the traditional voices to find the courage to resist and call out what President Trump is doing. If disagreements can't be stated openly or asked on or acted on, that's really a very chilling thing.
One of the major driving forces behind the Trump administration in dealing with the Fed is trying to get rates down, particularly things like mortgage rates, rates on car loans. Last time the Fed cut, actually the yield went up. It's expected right now that the Fed is likely to cut this month again. What is the administration's options if, in fact, the Fed does cut this month in September and actually yields go up?
Well, first of all, David, I think you said the important thing. Markets are already pricing in cuts in rates. So if a rate cut is delivered as expected, I would be surprised if that had a substantial impact on long-term rates. I think what markets will be watching is less what happens in September than the signals that are sent with regard to the future. And I think there is a sense that if the Fed is moving towards the president's line, easy rates over everything else, I think the likelihood is that in such an environment, long-term rates would rise and take mortgage rates up with them. That's the kind of pattern we saw with the politicized 1970s Federal Reserve. It's the kind of pattern we avoided during the times of Chairman Volcker and Chairman Greenspan. So I think that's something very much to worry about, and it's why I'm not sure the president is proceeding wisely, even in his own terms, of aspiring towards lower rates that people see. I suppose if long-term rates go up, there are, of course, options to bring back in some form or other the quantitative easing that the president and his people have largely condemned, where the Fed goes in and buys up, or somebody goes in and buys up large quantities of long-term bonds, or in which pressures are applied to banks and pension funds to force them to buy long-term bonds. But if you start down that road, you are really, I think, very severely compromising the integrity of our financial system in ways that will have far-reaching consequences.